Coca-Cola has paid and raised its dividend every single year since 1963, meaning shareholders got a raise while doing absolutely nothing. Welcome to Dividend Investing. And if you've never heard of this before, buckle up because by the end of this video, everything you thought you knew about money is about to change. So let's start with the basics. What actually is a dividend? When you buy stock in a company, you're buying a tiny piece of that business. Some companies, when they make profits, decide to share a portion of those profits directly with their shareholders. That payment is called a dividend. Think of it like being a landlord, except instead of managing properties and dealing with broken toilets, you're collecting income just for owning shares of a company. Here's what makes this powerful. You don't have to do anything extra to receive dividends. You buy the shares, you hold the shares, and the money arrives in your brokerage account like clockwork. Many dividend paying companies distribute these payments every single quarter, meaning 4 times a year, money shows up without you lifting a finger. Now let's talk about yield, because this is where beginners often get confused. Dividend yield is simply the annual dividend payment divided by the stock's current price, expressed as a percentage. If a stock pays $2 per share annually and the current share price is $40, your yield is 5%. That means for every $1,000 you invest, you're earning $50 per year in dividends alone before any stock price growth. But here's a secret most beginners never discover. The real magic isn't just collecting dividends, it's what you do with them. Reinvesting your dividends means using those payments to buy even more shares, which then generate even more dividends, which buy even more shares. This is called compounding, and it's genuinely one of the most powerful forces in personal finance. Let me paint you a picture. Imagine you invest $10,000 in a dividend stock with a 5% yield. Year one, you collect $500 in dividends. You reinvest those. Now you have $10,500 working for you. Next year, you earn dividends on that higher amount. The year after, even more. Over decades, this snowball effect can turn modest initial investments into genuinely life-changing wealth. Now, not all dividend stocks are created equal, and this is critical. A super high yield can actually be a warning sign. When a company's stock price drops dramatically, the yield calculation makes it look attractive, but the underlying business might be in serious trouble. Chasing the highest yields without research is one of the biggest mistakes beginner investors make. Instead, look for dividend growth. Companies that have consistently increased their dividends year over year are often financially healthy businesses with strong cash flows. There's actually a group of companies called Dividend Aristocrats, which are S&P 500 companies that have raised their dividends for at least 25 consecutive years. These businesses have weathered recessions, market crashes, and global crises while still rewarding shareholders. Let's address the question everyone's thinking about. How much money do you actually need to start? The honest answer is less than you probably think. Most major brokerage platforms today have zero minimum deposits and allow fractional share investing. You can literally start with $20. The key isn't starting big, it's starting now and staying consistent. Here's another concept that will immediately change how you think about investing. Forget trying to time the market. Dividend investors win through time in the market. Every month you contribute consistently is another month your money is compounding. Missing the best trading days because you were waiting for the perfect entry point is a strategy that consistently underperforms simple, regular investing. Tax considerations also matter, and I want to be transparent here. Dividends can be taxed differently depending on your country, your tax bracket, and what type of account you hold your investments in. In many places, holding dividend stocks in tax-advantaged accounts can significantly boost your long-term returns. Please consult a financial professional for personalized tax advice. So here's your action plan. First, open a brokerage account if you don't already have one. Second, research financially stable companies with consistent dividend histories. Third, start investing whatever amount you can afford consistently. Fourth, turn on dividend reinvestment and leave it alone. Fifth, keep learning and keep adding to your portfolio. The people who build real wealth through dividends aren't geniuses. They're not lucky. They simply understood this system early, started before they felt ready, and stayed consistent when everyone else got distracted. The best time to start dividend investing was 10 years ago. The second best time is literally today. If this video helped you, subscribe because we're just getting started. There's so much more to learn, and the next video will go even deeper.